The Alchemy of Finance. Reading the Mind of the Market by George Soros. Your reader is Grover Gardner. Introduction. In a very real sense, this book is my life's work. It touches on many of my most abiding interests, and it brings together the two main strands in my intellectual development, one abstract and one practical. The abstract came first. Ever since I became conscious of my existence, I've had a passionate interest in understanding it, and I regarded my own understanding as the central problem that needed to be understood. To understand oneself is an impossible task. To achieve anything resembling knowledge, we must be able to draw a distinction between subject and object. Yet in this case, the two are the same. What one thinks is part of what one thinks about. Therefore, one's thinking lacks an independent point of reference by which it can be judged. It lacks objectivity. As an undergraduate, I studied economics, but I found economic theory highly unsatisfactory because it failed to come to grips with this problem. Indeed, it went through great contortions to avoid it. Economics seeks to be a science. Science is supposed to be objective, and it is difficult to be scientific when the subject matter, the participant in the economic process, lacks objectivity. I was greatly influenced at the time by Karl Popper's ideas on scientific method. I accepted most of his views, with one major exception. He argued in favor of what he called unity of method. That is, the methods and criteria that apply to the study of natural phenomena also apply to the study of social events. I felt that there was a fundamental difference between the two. The events studied by the social sciences have thinking participants. Natural phenomena do not. The participants' thinking creates problems that have no counterpart in natural science. The closest analogy is in quantum physics, where scientific observation gives rise to Heisenberg's uncertainty principle. But in social events, it is the participant's thinking that is responsible for the element of uncertainty, not the outside observer. Natural science studies events that consist of a sequence of facts. When events have thinking participants, the subject matter is no longer confined to facts, but also includes the participants' perceptions. The chain of causation does not lead directly from fact to fact, but from fact to perception, and from perception to fact. This would not create any insuperable difficulties if there were some kind of correspondence or equivalence between facts and perceptions. Unfortunately, that is impossible because the participants' perceptions do not relate to facts, but to a situation that is contingent on their own perceptions and therefore cannot be treated as a fact. Economic theory tries to sidestep the issue by introducing the assumption of rational behavior. People are assumed to act by choosing the best of the available alternatives, but somehow the distinction between perceived alternatives and facts is assumed away. The result is a theoretical construction of great elegance that resembles natural science, but does not resemble reality. It relates to an ideal world in which participants act on the basis of perfect knowledge, and it produces a theoretical equilibrium in which the allocation of resources is at an optimum. It has little relevance to the real world in which people act on the basis of imperfect understanding, and equilibrium is beyond reach. The relationship between the participants' understanding and the situation in which they participate continued to preoccupy me long after I left college. My first priority was to try and make a living, but in my spare time I wrote a philosophical treatise on the subject with the catchy title, The Burden of Consciousness. Unfortunately, the title was the best part of it. By the time I finished, I disagreed with my own presentation. I spent 3 years revising it. One day I reread what I had written the day before, and I could not make head or tail of it. It made me realize that I had reached a dead end, and I decided to give it up. That was when the practical streak in me began to dominate my intellectual development. If I had to sum up my practical skills, I would use one word: survival. When I was an adolescent, the Second World War gave me a lesson that I have never forgotten. I was fortunate enough to have a father who was highly skilled in the art of survival, having lived through the Russian Revolution as an escaped prisoner of war. Under his tutelage, the Second World War served as an advanced course at a tender age. As the reader shall see, the investment vehicle I created a quarter of a century later drew heavily on skills I learned as an adolescent. After leaving college, I had a number of false starts and finally became an international arbitrage trader in stocks, first in London and then in New York. When the European Common Market was formed in 1957, American investors became interested in European shares. I became a security analyst advising American institutions on their European investments, and for a brief period I ruled as a one-eyed king among the blind. My glory came to an abrupt end when President Kennedy introduced a so-called interest equalization tax, which effectively stopped purchases of foreign securities. I decided to put my money-making activities on the back burner and spent 3 years, from 1963 to 1966, revising The Burden of Consciousness. When I finally decided to return to the land of the living, I started a model portfolio that became a hedge fund, a mutual fund that employs leverage and uses various techniques of hedging, in 1969. I have been in charge of that fund ever since, although I delegated much of the responsibility to others between September 1981 and September 1984. The fund has grown from about $4 million at inception to nearly $2 billion, and most of the growth has been internally generated. Original investors have seen the value of their shares multiply 300-fold. No investment fund has ever produced comparable results. In the first 10 years of my business career, I had not much use for anything I had learned in college, and there was an almost total separation between my practical activities and my theoretical interests. Selling and trading in securities was a game I played without putting my true self on the line. All this changed when I became a fund manager. I was putting my money where my mouth was, and I could not afford to dissociate myself from my investment decisions. I had to use all my intellectual resources, and I discovered, to my great surprise and gratification, that my abstract ideas came in very handy. It would be an exaggeration to say that they accounted for my success, but there can be no doubt that they gave me an edge. I developed my own peculiar approach to investing, which was at loggerheads with the prevailing wisdom. The generally accepted view is that markets are always right. That is, Market prices tend to discount future developments accurately, even when it is unclear what those developments are. I start with the opposite point of view. I believe that market prices are always wrong, in the sense that they present a biased view of the future. But distortion works in both directions. Not only do market participants operate with a bias, but their bias can also influence the course of events. This may create the impression that markets anticipate future developments accurately, but in fact it is not present expectations that correspond to future events, but future events that are shaped by present expectations. The participants' perceptions are inherently flawed, and there is a two-way connection between flawed perceptions and the actual course of events, which results in a lack of correspondence between the two. I call this two-way connection reflexivity. In the course of my investment activities, I discovered that financial markets operate on a principle that is somehow akin to scientific method. Making an investment decision is like formulating a scientific hypothesis and submitting it to a practical test. The main difference is that the hypothesis that underlies an investment decision is intended to make money and not to establish a universally valid generalization. Both activities involve significant risk, and success brings a corresponding reward, monetary in one case and scientific in the other. Taking this view, it is possible to see financial markets as a laboratory for testing hypotheses, albeit not strictly scientific ones. The truth is, successful investing is a kind of alchemy. Most market participants do not view markets in this light. That means that they do not know what hypotheses are being tested. It also means that most of the hypotheses that are submitted to market testing are quite banal. Usually they amount to nothing more than the assertion that a particular stock is going to outperform the market averages. I had a certain advantage over other investors because at least I had an idea about the way financial markets operate. I would be lying, however, if I claimed that I could always formulate worthwhile hypotheses on the basis of my theoretical framework. Sometimes there were no reflexive processes to be found. Sometimes I failed to find them, and what was the most painful of all, sometimes I got them wrong. One way or another, I often invested without a worthwhile hypothesis, and my activities were not very different from a random walk. But I was attuned to reflexive processes in financial markets, and my major successes came from exploiting the opportunities they presented. My approach to the market was not as abstract as it sounds. It took an intensely personal, emotional form. Testing was closely associated with pain, and success with relief. When I asserted that markets are always biased, I was giving expression to a deeply felt attitude. I had a very low regard for the sagacity of professional investors, and the more influential their position, the less I considered them capable of making the right decisions. My partner and I took a malicious pleasure in making money by selling short stocks that were institutional favorites. But we differed in our attitudes to our own activities. He regarded only the other participants' views as flawed, while I thought that we had as good a chance of being wrong as anyone else. The assumption of inherently flawed perceptions suited my self-critical attitude. Operating a hedge fund utilized my training in survival to the fullest. Using leverage can produce superior results when the going is good, but it can wipe you out when events fail to conform to your expectations. One of the hardest things to judge is what level of risk is safe. There are no universally valid yardsticks. Each situation needs to be judged on its own merit. In the final analysis, you must rely on your instincts for survival. Thus, my engagement in running a hedge fund brought together both my abstract interests and my practical skills. I did not play the financial markets according to a particular set of rules. I was always more interested in understanding the changes that occur in the rules of the game. I started with hypotheses relating to individual companies. With the passage of time, my interests veered increasingly toward macroeconomic themes. This was due partly to the growth of the fund and partly to the growing instability of the macroeconomic environment. For instance, exchange rates were fixed until 1973. Subsequently, they became a fertile field for speculation. For the past 4 or 5 years, I have had a growing sense of impending financial disaster. I felt that a long-lasting expansionary cycle was becoming increasingly unsound and unsustainable, and we were getting ready for a bust. That was one of the reasons I distanced myself from the active management of the fund in 1981 and reduced its overall level of exposure. My interest shifted from my own survival to the survival of the system. I made a study of the international debt problem and published some papers on the subject. I used the same theoretical framework as in my investment activities, and my analysis was not without merit. Unfortunately, the more complex the system, the greater the room for error. I made some mistakes in my analysis that detracted from the accuracy of my predictions. They also had a detrimental effect on my investment results until I revised my views in the course of writing this book. The more successful I had been in applying my ideas in financial markets, the keener I became to express them in theoretical form. I continued to cherish the fantasy that the concept of reflexivity constitutes a major contribution to our understanding of the world in which we live. I believed that the participant's bias is the key to an understanding of all historical processes that have thinking participants, just as genetic mutation is the key to biological evolution. But a satisfactory formulation of the theory of reflexivity continued to elude me. I always ran into trouble when I tried to define what I meant by the imperfect understanding of the participants. To speak accurately of a distortion, we must know what the situation would be if it were not distorted by the participants' perceptions. Unfortunately, that does not seem possible, because the participants' thinking is an integral part of the situation they have to think about. It is not surprising that the concept of reflexivity should present extreme difficulties. If it were an easier concept to work with, economists and other social scientists would not have gone to such lengths to banish it from their subject matter. This book is a final attempt to explore the implications of reflexivity. I have tried to circumvent the difficulties I encountered in the past by approaching the subject from the opposite direction. Instead of getting bogged down in abstract theory, I am going to draw on my experimental, practical findings to the greatest possible extent. I cannot avoid an abstract discussion altogether, but I have confined it to a single chapter. In exploring the practical implications, I start with the simplest cases and gradually lead up to more complex ones. This approach happens to coincide with the historical order in which I encountered reflexive developments in practice. First the stock market, then the currency market, then the international debt problem, and finally what may be called the credit cycle. The stock market provides some pure examples of a boom and bust pattern. Freely floating currency rates allow me to explore well-formed wave patterns. The boom and bust in international bank lending is part of a more complex historical process of credit expansion and eventual credit contraction. It has given rise to the configuration that I have dubbed Reagan's Imperial Circle. The configuration prevailed from the international debt crisis of 1982 until the first half of 1985, but it was inherently unstable. How the instability will be resolved is one of the main questions considered in this book. The experimental approach has borne unexpected results. I made two major discoveries in the course of writing. One is a reflexive connection between credit and collateral. The other is a reflexive relationship between the regulators and the economy they regulate. It has long been assumed that monetary values are a passive reflection of the state of affairs in the real world. Classical economics focused on the real world and neglected the problems connected with money and credit. Even Keynes couched his general theory in real terms. Monetarists sought to stand the relationship on its head. They argue that it is possible to control inflation by controlling the growth of the money supply. In my opinion, all these views are based on a fundamental misconception. Money values do not simply mirror the state of affairs in the real world. Valuation is a positive act that makes an impact on the course of events. Monetary and real phenomena are connected in a reflexive fashion. That is, they influence each other mutually. The reflexive relationship manifests itself most clearly in the use and abuse of credit. Loans are based on the lender's estimation of the borrower's ability to service his debt. The valuation of the collateral is supposed to be independent of the act of lending, but in actual fact, the act of lending can affect the value of the collateral. This is true of the individual case and of the economy as a whole. Credit expansion stimulates the economy and enhances collateral values. The repayment or contraction of credit has a depressing influence both on the economy and on the valuation of the collateral. The connection between credit and economic activity is anything but constant. For instance, credit for building a new factory has quite a different effect from credit for a leveraged buyout. This makes it difficult to quantify the connection between credit and economic activity, yet it is a mistake to ignore it. The monetarist school has done so, with disastrous consequences. The reflexive interaction between the act of lending and collateral values has led me to postulate a pattern in which a period of gradual, slowly accelerating credit expansion is followed by a short period of credit contraction, the classic sequence of boom and bust. The bust is compressed in time because the attempt to liquidate loans causes a sudden implosion of collateral values. Economic history has been punctuated by booms and busts. Nevertheless, the concept of a credit cycle is too simplistic to explain the course of events. For one thing, the connection between credit and economic activity is too tenuous and variable to yield a regular pattern. For another, the sequence of events is greatly complicated by the influence of economic policy. Periodic busts have been so devastating that strenuous efforts have been made to prevent them. These efforts have led to the evolution of central banking and of other mechanisms for controlling credit and regulating economic activity. To understand the role of the regulators, it must be realized that they are also participants. Their understanding is inherently imperfect, and their actions have unintended consequences. The relationship between the regulators and the economy is reflexive, and it also exhibits cyclical characteristics in the sense that it tends to swing from one extreme to another. What is the connection between the regulatory cycle and the credit cycle? At this point, my views become very tentative. I believe that the two cycles broadly overlap in time, that the minimum of regulations tends to coincide with the maximum of credit expansion, and vice versa. But within this chronological coincidence, there is constant interaction between the two cycles that influences the shape and duration of both. The interaction between the two cycles yields a unique path that cannot be fitted into any regular or repetitive pattern. I should like to emphasize that this book is not meant to provide a practical guide to getting rich in the stock market. Most of what I know is in the book, at least in theoretical form. I have not kept anything deliberately hidden. But the chain of reasoning operates in the opposite direction. I am not trying to explain how to use my approach to make money. Rather, I am using my experiences in the financial markets to develop an approach to the study of historical processes in general and the present historical moment in particular. If I did not believe that my investment activities can serve that purpose, I would not want to write about them. As long as I am actively engaged in business, I would be better off to keep them a trade secret. But I would value it much more highly than any business success if I could contribute to an understanding of the world in which we live, or, better yet, if I could help to preserve the economic and political system that has allowed me to flourish as a participant. The theory of reflexivity. Economic theory is devoted to the study of equilibrium positions. The concept of an equilibrium is very useful. It allows us to focus on the final outcome rather than on the process that leads up to it. But the concept is also very deceptive. It has the aura of something empirical. Since the adjustment process is supposed to lead to an equilibrium position seems somehow implicit in our observations. That is not true. Equilibrium itself has rarely been observed in real life. Market prices have a notorious habit of fluctuating. The process that can be observed is supposed to move toward an equilibrium. Why is it that the equilibrium is never reached? It is true that market participants adjust to market prices, but they may be adjusting to a constantly moving target. In that case, calling the participants' behavior an adjustment process may be a misnomer, and equilibrium theory becomes irrelevant to the real world. Equilibrium is the product of an axiomatic system. Economic theory is constructed like logic or mathematics. It is based on certain postulates, and all of its conclusions are derived from them by logical manipulation. The possibility that equilibrium is never reached need not invalidate the logical construction, but when a hypothetical equilibrium is presented as a model of reality, a significant distortion is introduced. If we lived in a world in which the angles of a triangle did not add up to 180 degrees, Euclidean geometry would constitute such a misleading model. The crowning achievement of the axiomatic approach is the theory of perfect competition. Although it was first propounded nearly 200 years ago, it has never been superseded. Only the method of analysis has been refined. The theory holds that under certain specified circumstances, the unrestrained pursuit of self-interest leads to the optimum allocation of resources. The equilibrium point is reached when each firm produces at a level where its marginal cost equals the market price, and each consumer buys an amount whose marginal utility equals the market price. Analysis shows that the equilibrium position maximizes the benefit of all participants, provided no individual buyer or seller can influence market prices. It is this line of argument that has served as the theoretical underpinning for the laissez-faire policies of the 19th century, and it is also the basis of the current belief in the magic of the marketplace. Let us examine the main assumptions of the theory of perfect competition. Those that are spelled out include perfect knowledge, homogeneous and divisible products, and a large enough number of participants so that no single participant can influence the market price. The assumption of perfect knowledge is suspect because understanding a situation in which one participates cannot qualify as knowledge. That was the assumption that I found so unacceptable as a student. I have no doubt that classical economists used the assumption in exactly that sense in which I found it objectionable, because 19th century thinkers were less aware of the limitations of knowledge than we are today. As the epistemological problems began to surface, exponents of the theory found that they could get by using a more modest word, information. In its modern formulation, the theory merely postulates perfect information. Unfortunately, this assumption is not quite sufficient to support the construction of the theory. To make up for the deficiency, modern economists resorted to an ingenious device. They insisted that the demand and supply curves should be taken as given. They did not present this as a postulate, rather they based their claim on methodological grounds. They argued that the task of economics is to study the relationship between supply and demand, and not either by itself. Demand may be a suitable subject for psychologists, supply may be the province of engineers or management scientists. Both are beyond the scope of economics. Therefore, both must be taken as given. Yet, if we stop to ask what it means that the conditions of supply and demand are independently given, it is clear that an additional assumption has been introduced. Otherwise, where would those curves come from? We are dealing with an assumption disguised as a methodological device. Participants are supposed to choose between alternatives in accordance with their scale of preferences. The unspoken assumption is that the participants know what those preferences and alternatives are. As I shall try to show, this assumption is untenable. The shape of the supply and demand curves cannot be taken as independently given because both of them incorporate the participants' expectations about events that are shaped by their own expectations. Nowhere is the role of expectations more clearly visible than in financial markets. Buy and sell decisions are based on expectations about future prices, and future prices, in turn, are contingent on present buy and sell decisions. To speak of supply and demand as if they were determined by forces that are independent of the market participants' expectations is quite misleading. The situation is not quite so clear-cut in the case of commodities, where supply is largely dependent on production and demand on consumption. But the price that determines the amounts produced and consumed is not necessarily the present price. On the contrary, market participants are more likely to be guided by future prices, either as expressed in futures markets or as anticipated by themselves. In either case, it is inappropriate to speak of independently given supply and demand curves because both curves incorporate the participants' expectations about future prices. The very idea that events in the marketplace may affect the shape of the demand and supply curves seems incongruous to those who have been reared on classical economics. The demand and supply curves are supposed to determine the market price. If they were themselves subject to market influences, prices would cease to be uniquely determined. Instead of equilibrium, we would be left with fluctuating prices. This would be a devastating state of affairs. All the conclusions of economic theory would lose their relevance to the real world. It is to prevent this outcome that the methodological device that treats the supply and demand curves as independently given was introduced. Yet there is something insidious about using a methodological device to obscure an assumption that would be untenable if it were spelled out. To preserve the integrity of economic theory as an axiomatic system, its assumptions ought to be explicitly stated. We may then conclude that economic theory is no more relevant to the real world than non-Euclidean geometry, but at least we would know where we stand. Instead, we have been deceived by a methodological subterfuge. The demand and supply curves are presented in textbooks as though they were grounded in empirical evidence. But there is scant evidence for independently given demand and supply curves. Anyone who trades in markets where prices are continuously changing knows that participants are very much influenced by market developments. Rising prices often attract buyers and vice versa. How could self-reinforcing trends persist if supply and demand curves were independent of market prices? Yet even a cursory look at commodity, stock, and currency markets confirms that trends are the rule rather than the exception. The theory of perfect competition could be defended by arguing that the trends we can observe in commodity and financial markets are merely temporary aberrations which will be eliminated in the long run by the fundamental forces of supply and demand. It should be remembered that the theory of perfect competition does not claim to define the path of adjustment. It merely analyzes the situation after all the adjustments have taken place. The trouble with the argument is that there can be no assurance that fundamental forces will correct speculative excesses. It is just as possible that speculation will alter the supposedly fundamental conditions of supply and demand. In the normal course of events, a speculative price rise provokes countervailing forces. Supply is increased and demand reduced, and the temporary excess is corrected with the passage of time. But there are exceptions. In foreign exchange, for example, a sustained price movement can be self-validating because of its impact on domestic price levels. The same is true in the stock market, where the performance of a stock may affect the performance of the company in question in a number of ways. And in examining the recent history of international lending, we shall find that excessive lending first increased the borrowing capacity of debtor countries, as measured by their debt ratios, and then, when the banks wanted to be repaid, the debtor countries' ability to do so evaporated. Generally speaking, we shall find that the expansion and contraction of credit can affect the debtor's ability and willingness to pay. Are these exceptions that confirm the rule, or do they necessitate a revision of accepted theory? The answer depends on the frequency and severity of their occurrence. If we are dealing with an isolated instance, we can treat it as a paradox, but if one incident follows another, we must question the theory. I contend that such paradoxical behavior is typical of all financial markets that serve as a discounting mechanism for future developments, notably stock markets, foreign exchange markets, banking, and all forms of credit. Microeconomic theory may continue to ignore it because there are large areas of economic activity where it occurs only occasionally or not at all. But we cannot expect to understand macroeconomic developments without taking the phenomenon into account. A world of fluctuating exchange rates and large-scale capital movements is characterized by vicious and benign circles in which the normal pattern of causation, as defined by classical economics, seems to be reversed. Market developments dictate the evolution of the conditions of supply and demand, not the other way around. If the process of adjustment does not lead to an equilibrium, what happens to the conclusions of economic theory? The answer is that they remain valid as deductions, but they lose their relevance to the real world. If we want to understand the real world, we must divert our gaze from a hypothetical final outcome and concentrate our attention on the process of change that we can observe all around us. This will require a radical shift in our thinking. A process of change is much more difficult to understand than a static equilibrium. We shall have to revise many of our preconceived ideas about the kind of understanding that is attainable, and satisfy ourselves with conclusions that are far less definite than those that economic theory sought to provide. The understanding of the actual course of events, as distinct from a hypothetical equilibrium, poses problems that have not been properly appreciated. The problems arise because participants base their decisions on an inherently imperfect understanding of the situation in which they participate. My approach is to tackle the problem of imperfect understanding head-on. What makes the participants' understanding imperfect is that their thinking affects the situation to which it relates. The causal role played by the participants' thinking has no counterpart in the phenomena studied by natural scientists. It is obviously not the only force shaping the course of events, but it is a force which is unique to events that have thinking participants. Hence it deserves to take center stage. As we have seen, imperfect understanding is a very difficult concept to work with. We have established that there is a lack of correspondence between the participants' thinking and the situation to which it relates. But the lack of correspondence is difficult to define, let alone measure. The participants' thinking is part of the situation to which it relates, and the very idea of correspondence is inappropriate to describing a relationship between a part and a whole. The idea was imported from natural science, where facts and statements belong to separate universes, and from philosophy, where correspondence serves as the criterion of truth. The analogy does not apply to the participant, who is, by definition, part of the situation that he is trying to understand. We can speak of a lack of correspondence, but we cannot define that to which the participant's understanding fails to correspond, because it simply does not exist. To simplify matters, I shall speak of an inherent bias in the participant's thinking. since the bias is inherent, the unbiased is unattainable. There is, however, a norm in the outside world against which the participant's bias can be measured. Although there is no reality independent of the participant's perception, there is a reality that is dependent on it. In other words, there is a sequence of events that actually occurs, and that sequence reflects the participant's behavior. The actual course of events is likely to differ from the participant's expectations, and the divergence can be taken as an indication of the participant's bias. Unfortunately, it can be taken only as an indication, not as the full measure of the bias, because the actual course of events already incorporates the effects of the participant's thinking. Thus, the participant's bias finds expression both in the divergence between outcome and expectations and in the actual course of events. A phenomenon that is partially observable and partially submerged in the course of events does not lend itself readily to scientific investigation. We can now appreciate why economists were so anxious to eliminate it from their theories. We shall make it the focal point of our investigation. The connection between the participants' thinking and the situation in which they participate can be broken up into two functional relationships. I call the participants' efforts to understand the situation the cognitive or passive function, and the impact of their thinking on the real world the participating or active function. In the cognitive function, the participants' perceptions depend on the situation. In the participating function, the situation is influenced by the participants' perceptions. It can be seen that the two functions work in opposite directions. In the cognitive function, the independent variable is the situation. In the participating function, it is the participant's thinking. There are many cases where one or the other function can be observed in isolation, but there are also instances where they are both operating at the same time. An obvious example of the cognitive function is when someone learns from experience. Examples of the participating function are to be found in textbooks of economics, where the participants apply a given set of preferences to a given set of opportunities and in the process determine prices. When both functions operate at the same time, they interfere with each other. Functions need an independent variable in order to produce a determinate result, but in this case the independent variable of one function is the dependent variable of the other. Instead of a determinate result, we have an interplay in which both the situations and the participants' views are dependent variables, so that an initial change precipitates further changes both in the situation and in the participants' views. I call this interaction reflexivity, using the word as the French do when they describe a verb whose subject and object are the same. This is the theoretical foundation of my approach. The two recursive functions do not produce an equilibrium, but a never-ending process of change. When a situation has thinking participants, the sequence of events does not lead directly from one set of facts to the next. Rather, it connects facts to perceptions, and perceptions to facts in a shoelace pattern. Thus, the concept of reflexivity yields a shoelace theory of history. Returning to economic theory, it can be argued that it is the participant's bias that renders the equilibrium position unattainable. The target toward which the adjustment process leads incorporates a bias, and the bias may shift in the process. When that happens, the process aims not at an equilibrium, but at a moving target. How significant is the distortion introduced by neglecting the participant's bias? In microeconomic analysis, the distortion is negligible and the participant's bias can be accounted for easily. As a first step, the participant's bias can be taken as given. That provides a static equilibrium. To make the analysis more dynamic, changes in the participant's bias can be added piecemeal, expressed as changes in consumer habits or production methods. All that is obscured by this piecemeal approach is the possible connection between the various changes in the conditions of supply and demand. But that omission does not invalidate the conclusions microeconomic analysis seeks to establish. When it comes to financial markets, the distortion is more serious. The participant's bias is an element in determining prices, and no important market development leaves the participant's bias unaffected. The search for an equilibrium price turns out to be a wild goose chase, and theories about the equilibrium price can themselves become a fertile source of bias. To paraphrase J.P. Morgan, financial markets will continue to fluctuate. In trying to deal with macroeconomic developments, equilibrium analysis is totally inappropriate. Nothing could be further removed from reality than the assumption that participants base their decisions on perfect knowledge. People are groping to anticipate the future with the help of whatever guideposts they can establish. The outcome tends to diverge from expectations, leading to constantly changing expectations and constantly changing outcomes. The process is reflexive. In his General Theory of Employment, Interest, and Money, Keynes managed to show that full employment is a special case. If we could develop a general theory of reflexivity, equilibrium would appear as a special case. While it will hardly qualify as a general theory, I shall try to explore the role of reflexivity in financial markets. That means that I shall try to interpret their functioning as a historical process. Reflexivity in the stock market. In trying to develop a theory of reflexivity, I shall start with the stock market. For one thing, it is the market I am most familiar with. I have been a professional investor for more than 25 years. For another, the stock market provides an excellent laboratory for testing theories. Changes are expressed in quantitative terms, and the data are easily accessible. Even the participants' views are usually available in the form of brokers' reports. Most important, I have actually tested my theory in the stock market, and I have some interesting case studies to present. As I mentioned in the introduction, I did not develop my ideas on reflexivity in connection with my activities in the stock market. The theory of reflexivity started out as abstract philosophical speculation, and only gradually did I discover its relevance to the behavior of stock prices. I was singularly unsuccessful in formulating my theory at the level of abstraction at which I conceived it. My failure as a philosopher stands in stark contrast with my career as an investment professional. I hope that by presenting my ideas in the reverse order from the one in which I arrived at them, I may be able to avoid getting lost in arcane abstractions. There is yet another reason why the stock market may provide the best entry point for the study of reflexive phenomena. The stock market comes as close to meeting the criteria of perfect competition as any market. A central marketplace, homogeneous products, low transaction and transportation costs, instant communications, a large enough crowd of participants to ensure that no individual can influence market prices in the ordinary course of events, and special rules for insider transactions, as well as special safeguards to provide all participants with access to relevant information. What more can one ask for? If there is any place where the theory of perfect competition ought to be translated into practice, it is in the stock market. Yet there is little empirical evidence of an equilibrium, or even a tendency for prices to move toward an equilibrium. The concept of an equilibrium seems irrelevant at best and misleading at worst. The evidence shows persistent fluctuations, whatever length of time is chosen as the period of observation. Admittedly, the underlying conditions that are supposed to be reflected in stock prices are also constantly changing, but it is difficult to establish any firm relationship between changes in stock prices and changes in underlying conditions. Whatever relationship can be established has to be imputed rather than observed. I intend to use the theory of reflexivity to criticize the preoccupation of economic theory with the equilibrium position. What better example could I find than the stock market? Existing theories about the behavior of stock prices are remarkably inadequate. They are of so little value to the practitioner that I am not even fully familiar with them. The fact that I could get by without them speaks for itself. Generally, theories fall into two categories: fundamentalist and technical. More recently, the random walk theory has come into vogue. This theory holds that the market fully discounts all future developments so that the individual participant's chances of over- or underperforming the market as a whole are even. This line of argument has served as theoretical justification for the increasing number of institutions that invest their money in index funds. The theory is manifestly false. I have disproved it by consistently outperforming the averages over a period of 12 years. Institutions may be well advised to invest in index funds rather than making specific investment decisions, but the reason is to be found in their substandard performance, not in the impossibility of outperforming the averages. Technical analysis studies market patterns and the demand and supply of stocks. It has undoubted merit in predicting probabilities, but not the actual course of events. For the purposes of this discussion, it is of no particular interest because it has little theoretical foundation other than the assertions that stock prices are determined by their supply and demand, and that past experience is relevant in predicting the future. Fundamental analysis is more interesting because it is an outgrowth of equilibrium theory. Stocks are supposed to have a true or fundamental value as distinct from their current market price. The fundamental value of a stock may be defined either in relation to the earning power of the underlying assets or in relation to the fundamental value of other stocks. In either case, the market price of a stock is supposed to tend toward its fundamental value over a period of time, so that the analysis of fundamental values provides a useful guide to investment decisions. The important point about this approach is that the connection between stock prices and the companies whose stocks are traded is assumed to be in one direction. The fortunes of the companies determine, however belatedly, the relative values of the various stocks traded in the stock market. The possibility that stock market developments may affect the fortunes of the companies is left out of account. There is a clear parallel with the theory of price, where the indifference curve determines the relative amounts consumed, The possibility that the market may influence the indifference curve is disregarded. The parallel is not accidental. The fundamentalist approach is based on the theory of price. But the omission is more glaring in the stock market than in other markets. Stock market valuations have a direct way of influencing underlying values, through the issue and repurchase of shares and options, and through corporate transactions of all kinds, mergers, acquisitions, going public, going private, and so on.